عليكم ورحمة الله وبركاته. اللهم صل على سيدنا محمد وعلى آل سيدنا محمد وبارك وسلم. ربنا آتنا في الدنيا حسنة وفي الآخرة حسنة وقنا عذاب النار. Good morning and assalamu alaikum to all our guests, clients, service providers, and potential clients that are joining us this morning for our presentation by Dr. Azar Jammine on the economy and the effects of COVID on the South African economy. This webinar is brought to you by Al Baraka Bank, your partner bank. We represented across 17 countries globally, and we service your needs with regards to investments, financing, transactional banking, foreign exchange, and wealth through our 7 branches in South Africa. Throughout the COVID-19 pandemic, we have been open and operational in order to assist our clients across the country. Just very briefly, Dr. Jammine will be giving us feedback on the economy. There will be Q&As that's allowed. During the presentation, please feel free to make use of the Q&A functionality on the Zoom platform, and that will then be collated and shared with Dr. Jammine at the end of the presentation. The presentation will run for exactly 40 minutes, and we'll have a space of 10 minutes for Q&A at the end. Just a short background on our guest. Dr. Jammine is the Director and Chief Economist of Econometrix South Africa. It's a leading independent economic research consultancy and forecasting company established in 1982. He has been in his current position since December 1985 and has established a significant profile in South Africa as an analyst and commentator on domestic and international economic affairs. Dr. Jammine has conducted more than 5,000 presentations to leading client corporations and other institutions, as well as conferences dealing with the local and international economic environment. In his capacity, he's also been invited over the years by several corporations to serve as independent non-executive director. Dr. Jammine recently retired as a member of the National Advisory Council on Innovation, a body of experts appointed by the Department of Science and Technology, but still assists on an ad hoc basis as an expert on various tasks. Academically, Dr. Jammine obtained his BSc in Mathematical Statistics and a BA Honours in Economics at WITS, followed by a Master's in Economics from the LSE and PhD in the London Business School. Dr. Jammine, over to you. Thank you very much, and welcome to Al Baraka and to our.
Good morning. Thank you very much, Mohammed, and thank you so much to all who are participating in this to actually share in this presentation on the impact of the COVID virus on the South African economy. I would like to take you through a number of slides in the course of my presentation, and you will then be free to ask questions at the end. Let me just give you a context of the COVID outbreak and what South Africa's position is. I think it's standard knowledge that South Africa intervened fairly early in the spread of the virus in this country to try and quell it through lockdowns. And I think it's met with a relative amount of success in that regard in 2 important areas. Firstly, as you can see from this chart, the fatality rate that's the number of people dying from the virus as a percentage of the number of people contracting the virus has been far lower than that of other countries. I've given a couple of examples here, but in South Africa, basically, there is 1 fatality for every 45 people who actually contract the virus, or 2.2% rate of death. And that compares with a global average of 5.6%. China achieved 5.5%. Even Germany, that is the admiration of many countries in the way it's conducted in the fight against COVID, 4.7%. And then countries like Italy, France, the UK, and Spain have been in the order of 14 to 15 deaths for every 100 that actually contract the disease. So you can see we've done relatively well there. We've also done relatively well in terms of our recovery rate. The last figure that I saw for yesterday, basically 55% of all the people who've contracted the COVID virus in South Africa have recovered from it already. And that is higher than the global average currently of 49%. However, there are some warning signs. If one looks at the number of infections after the first 100 days of the first infection being recorded, you can see that initially many countries saw a far worse outcome than South Africa, but the curve has flattened in many of those instances, and in some cases it's even declined. Whereas in South Africa, it has just carried on increasing at a fairly steady pace. There's no sign of a peaking in the rate of infection. And you can see the difference, for example, between us and the United States, where the number of confirmed cases, the growth in the number of confirmed cases per day in South Africa has remained in a range of between 4% and 8% now for the better part of 2 months, whereas in the United States it began at a very high pace but has leveled off quite significantly. The number of people who contract who have been identified as contracting the virus is clearly very correlated with the number of tests conducted every day. But in South Africa's case, after remaining fairly constant at around 2.5% recorded cases for every of all the tests conducted, we have seen that increasingly now the number of positive cases coming out of tests has been increasing steadily. And yesterday we had over 8% of tests conducted recording positively. So what has caused this sudden and fairly sharp increase in the rate of infections per test? And to some extent, this was quite well explained by Professor Salim Abdul Karim from the University of KZN, who is head of South Africa's medical team that advises the government. In a presentation he conducted about 2 months ago, he actually illustrated that the initial phase of the spread of the virus came from people traveling from overseas into South Africa. They were easily identified, quarantined, and we were able to control the spread of the virus from amongst them. However, then was the case of all the people that they had come into contact with, including medical personnel. And what we saw is that that curves increased sharply, but we again were able to identify and trace most of these people, and were able to get them to quarantine appropriately. However, what has, I think, caused the sharp increase in the rate of positive infections that we are now seeing is this exponential increase in, I think, the virus finally got out into what is known as the communities. That is, people living in informal settlements and in townships where they're living closely, cheek by jowl with one another. And that is now starting to spiral. What has, however, been very evident and probably not highlighted sufficiently in South Africa, and we don't quite understand the reason, is the very high concentration of infections in the Western Cape. The Western Cape accounts for 66% of all infections measured thus far, and 77% of all fatalities. KwaZulu-Natal, you can see, is only around 6% of all fatalities, and the amazing one is Gauteng, with just 4.7% of all fatalities, despite having Alexandra Township and Shoshanguve and Diepsloot and other places where people also live very closely and cannot conduct social distancing. You'll also notice from this that the Eastern Cape, that's the black part, has seen a quite a significant increase in number of fatalities and infections. And this is also a function of the fact that when we moved from level 5 to level 4, a lot of people were allowed to move once off across provincial boundaries, and many of them moved from the Western Cape to the Eastern Cape. But this heavy concentration in the Western Cape raises questions about whether a national lockdown with national restrictions that apply everywhere is the right way of coping with this. It also casts questions as to whether it's appropriate, for example, to reinstitute flights between Johannesburg and Cape Town. Will that not lead to the virus spreading significantly into Johannesburg areas? And by the way, a high incidence in the Western Cape is not just a function of the high number of tests being conducted in that province. There's more to it than that. Some say that the people in the Western Cape have just not been following the rules of social distancing as appropriately as in other provinces. I'd now like to move on to the sources of the economic impact of the COVID-19 lockdown. First of all, why are we seeing economic activity so badly affected? Firstly, we've got the supply side impact. Because of lockdowns in different countries, starting with China, we have shortages of products being able to be imported into the country, and this impacts negatively in terms of the ability of companies to have the components with which to produce, even for export. Secondly, is the one that I think most people like to focus on, the demand side impact, which is the disruption to business activity from social distancing and lockdowns, which has resulted in a drying up of cash flows almost overnight in businesses, especially in the likes of travel and transport and leisure activities, restaurants, events management companies. And of course, many of the retailers were obliged to stay shut for an extended period of time through lockdowns 5 and 4. And that meant that shopping centers no longer received rentals from almost half their clients. The third negative, which doesn't affect South Africa as badly as it has done internationally, is the collapse in oil prices, which was nothing short of spectacular, moving down from around $60 a barrel to below $20 a barrel for Brent crude. And in fact, in the American crude prices at one point fell to negative levels because producers had no place to store the oil and were just paying people to take it off them. But we have seen some rally since then. But in South Africa's case, the impact has been mainly confined to Sasol. And conversely, in fact, it's had a positive impact in terms of driving down the price of fuel, which has enhanced the disposable income of people. The fourth effect is one that has probably dissipated largely, but initially when we had that horrific crash on equity markets in March, I thought, wow, there's going to be a negative impact on the solvency of many financial institutions, and also pensioners would be negatively affected and would spending less, and you'd have a knock-on effect on the economy from that source. But since then, of course, markets have rallied very, very strongly and are almost back to where they were before March. And then the fifth negative impact is the strain on the banking sector. We're going to see a lot of bad debts accruing over the next and impairments over the next few months, and that is going to impact negatively on the banks, who have also been exhorted by the Reserve Bank and others to be very forgiving in terms of the not being very demanding on the interest that is paid and providing debt relief holidays for an extended period of months and so on to clients. But it is putting a strain on the banking system. One element that I'd like to just briefly comment on is the performance on the Johannesburg Stock Exchange of different sectors in response to the COVID lockdown. And what has been fascinating is to see that precisely those sectors where you would have expected to see a positive reaction because they have, if anything, benefited from the lockdown, those shares have done proportionately far better than the average. And conversely, those sectors where you would have expected a lot of pain have done worse than the average of all shares. For example, your medically related sectors in medical manufacturing, health retailers, and medical services have been outperforming the markets. If you look at food retailers, they were allowed to carry on operating. The big ones were listed. They did very well. Your IT and communications companies have outperformed the average. On the other side of the coin, you've got your the worst performer, as one would have expected. That purple line at the bottom is, of course, your hospitality and airline sectors, but also in a similar company, you find your commercial banks, your property-related companies, and your non-food retailers who had to be closed for 2 months, and that kind of thing. So it's totally logical in terms of the performance that we have seen on the stock exchange. It's starting to change, as you can see. For example, hopes of an opening up of hospitality and airline is seeing an upward bounce in that sector, but medical manufacturing, the top one, is really outperforming the rest of the market. What has been the experience of the South African economy thus far to the pain that we have seen? For one thing, you'll notice that the level of insolvencies was already increasing substantially from the early part of 2018 through to the early part of 2020, and then it dipped in February, but we don't have up-to-date figures for what follows in April and has followed in April and May, because the offices to measure these insolvencies were closed down. But I suppose it is a fair bet that one will see an increase in those insolvencies. Against this, of course, the whole concept of business rescue as opposed to insolvencies has been gaining significant ground in recent years. And so that is why you end up with a seeming pattern where the number of insolvencies is a lot lower than it was a decade ago overall. One of the hard data available were new passenger vehicle sales, and you can see how in April sales plummeted. I think 105 cars were sold in South Africa, so it was a minus 99% decline. It recovered somewhat to minus 68% in May, because halfway through the month the government allowed auto dealers to open up at least partially to 1/3 of their operations. So that's one indication. The last couple of months have seen some crazy graphs like these. I'll show you one a little later. The other big one that we had reported yesterday was business confidence, where it fell to easily the lowest level ever on record of 5 points, which suggests that 95 out of every 100 respondents basically has lost confidence in the economic future. But basically, Statistics South Africa has not been able to measure a lot of the economy in recent times because of the shutdown. So what they did, I thought, was quite innovative. They did a number of surveys amongst businesses online to see how they had been affected by the COVID-19 lockdowns. And the results, I think, are to some extent reassuring in that they suggest that the outcome has not been any worse than one might have expected. But it is interesting to note that it has nonetheless been fairly severe. And they did 2 important surveys, one in the first 3 weeks of lockdown and the next in the following 2 weeks. And to some extent, you can see a deterioration even between those 2 sessions. The figures in bracket refer to the results from the first sample survey, the second from the second and the ones not in bracket are the more recent ones in the second period of lockdown level 5 from April 14th to April 30th. What they show is the proportion of businesses experiencing a decline in turnover was nearly 90% in the second sample, up from 85% in the first sample. The proportion of businesses that had been forced to either close or halt production rose to 48%. In other words, nearly half of the economy was shut down during this level 5. What is interesting is the third point, that the proportion of businesses that had to shut down was very closely related to the size of businesses. Those with turnover of less than 2 million rand, 58% of them had to shut down, whereas businesses with turnover of more than 1 billion rand, only 22% shut down. So the impact of the lockdown has been proportionately much more severe on smaller companies. What you also see is that almost half, that's 45.6% of companies, are expecting to end this whole period with a smaller workforce than they began with. And that is obviously a recipe for increased unemployment that we're likely to see. And what was quite sobering is to see that the proportion of companies seeing themselves as surviving the lockdown was as high as 55.7%, were in other words, was as low as 55.7%. In other words, nearly half companies had difficulty in perceiving that, in being confident that they'd see through this whole crisis and still be operating. People are finding it far worse than the 2008-09 crisis. What is interesting also is to see how the supply chain disruptions are also impacting negatively on production, as much as just 52.5% of companies found that they could actually operate with the required find the required materials for their production processes. In other words, nearly half could not do so. And it's therefore interesting to see that this is linked to the next point to some extent, that there has been there was an indication of fairly sharp increases in the prices of many goods during the lockdown. Only 37.7% of companies had not seen a deterioration in their financial position. And what are companies doing to save themselves in this environment? About 30% accessed the temporary employee relief scheme through the UIF. Another 23% tried to benefit from delaying PAYE payments according to the rules that were provided to provide some relief there. Just over 20% had received some debt relief from banks, and another 18.5% had relied on loans, grants from some of the trusts that have been established, such as the Solidarity Fund and the big donations by the Rupert and Oppenheimer Foundations. Subsequently, 1 week later, the first week of March, another survey was conducted amongst companies to see what the impact was on incomes and employment. And I don't know if one can be encouraged or discouraged. About 90% of companies' workforces that, as they went into lockdown, were still intact by May the 6th. I suppose that means 10% or so had lost their jobs. That's, I suppose, fairly logical and is not worse than one would have expected, at least. What has been interesting when I analyzed the respondents to the survey, I found that a bigger hit was taken by businesses owned by Black Africans and Coloreds than on the businesses owned by whites and Indians. You'll see, for example, that even though more than 3/4 of businesses who responded to the survey are white-owned, only 72% of the businesses who had been forced to close were white-owned, whereas with Black Africans, just 14.6% of the respondents were Black-owned, but they accounted for nearly 20% of all the closures. And it's an indication of the point that I'm going to make later, that one of the effects of this COVID-19 virus has been to increase inequality around the world, not just in South Africa. In terms of the proportion of business closures, interestingly, the Western Cape, even though it accounted for only 18% of respondents, accounted for nearly a third of all business closures. And that's because it's so heavily concentrated in the hospitality and tourism sectors and the wine industry that was shut down during the lockdown. KZN, you can see 7.3%, neither here nor there, roughly in line with what one would have expected, in line with its relative importance in the business sector. Maybe a bit low, actually. It hasn't been anywhere near as hard hit as the Western Cape. About 21% of people who are employed said that they had suffered a decrease in their incomes. And many of those who lost their jobs lost them either because the businesses for which they were working were shut down, or because of the businesses that they'd been working for had suffered a dramatic loss in business and had to lay them off, which is quite logical. Alarmingly, only 47% of those with paid jobs or businesses or owning businesses were confident of seeing through the COVID crisis, more or less in line with the finding on the previous survey that I showed you. So what has the South African government done to try and resolve this problem? It's announced a 500 billion, it called it a stimulus package. It's really a rescue package, which incorporates a 50 billion rand in extra social grant payments, 2 billion rand to help informal sector, another 40 billion theoretically earmarked through the UIF to supplement salaries of people not working. Thus far, only 7 billion has been dispersed. There are clearly huge bureaucratic and administrative challenges, not enough people working for the UIF to vet all the applications for those extra funds. There's been a 200 billion loan guarantee package being arranged through banks and the Reserve Bank, but again, only 12 billion has thus far actually been allocated. And then we had a 20 billion set aside to purchase healthcare equipment, 20 billion to be dispersed to municipalities. 70 billion rand was suggested would be the benefit to consumers and businesses by deferring tax payments. And of course, there was the additional 100 billion benefit from the stimulus provided by a 2.5% cut in the repo rate between March and May. And I'll come to that in a moment. But so some people are encouraged and they say that's 9.5% of our GDP, which is comparable to the average 10.3% of world GDP stimulus being invoked by the world as a whole, of which the United States is about a third. But what isn't fully recognized is that a lot of these packages that have been announced actually don't involve new money from the government. Some of them do, like the 50 billion for extra social grant payments and the 20 billion to purchase healthcare equipment and to go to municipalities. But the 40 billion from the UIF is not new money. The 100 billion and 200 billion in loan guarantees is also not new money. It's money that's going to have to be repaid. And similarly for the 70 billion additional benefit through deferring tax payments. Ultimately, people will need to pay that. So overall, the stimulus is really only of the order of 150 billion rand. Now, depending what your ideological stance is, does that mean controlled over government spending or not? It is something that you'll need to think about yourself. There are those who say we shouldn't be worried about government's borrowing requirements. We should just be spending like crazy now. Well, the Treasury has tried to avoid going berserk on that score. The benefit of lower interest rates is significant. At the beginning of the year, we had a prime rate of 10%. It's now a prime rate of 7.25%. That means that debt servicing costs of the average business and consumer have come down by 27.5% since the beginning of the year. So in other words, if you were paying 10,000 Rand a month interest at the beginning of the year, you're now saving 2,750 Rand a month on interest that you would otherwise have been paying. It's fairly substantial. And worldwide, we've just followed the worldwide pattern of massive cuts in interest rates. This is just an attempt to show you how big the cuts have been in several different countries. But probably the biggest stimulus of all has been in the United States, where the central bank has been buying up bonds from the financial sector and pumping in trillions of dollars into the US economy. And central banks like the ECB and the Bank of Japan and the Bank of England have followed the same pattern. And we are seeing an unprecedented amount of new money being injected to the global financial system. And it is no wonder then that you are now finding the share prices are doing so well. Who would fight against central banks when they are pouring so much money into the global financial system? It's quite tricky to make forecasts for economic growth in the current environment, partly because two of the very big unknowns are, if countries lift the lockdown from their economies, are we going to see an explosion of a second wave of infections? And the second unknown is when we're going to see a vaccine to quell this virus. Consequently, the inclination of most economists, we first and foremost 2 months ago when we did this, was to say, one really can only forecast different scenarios, if this, then that. And the three scenarios that are typically looked at is a V-shaped scenario, quick recovery and back to the races, in which case the South African economy, we calculated, would contract by 3%. The second scenario was, no, it's going to take quite a while before we lift off from lockdowns, and we'll be depressed for most of the year and only come out of this recession next year. And that U-shaped scenario, looking at a minus 6.4% economic growth rate. These are horrific growth rates, by the way. Normally economists have arguments around, will growth be 0.2 or 0.5%, not whether it be 0.2 or minus 6.4%. And the third scenario is the L-shaped scenario that doesn't see much recovery, that sees permanent damage having been inflicted by the current virus. And we use that to show that the economy could contract by 12%. Well, since then, unfortunately, the lockdown has been greatly extended, and we are now being far more leaning towards the L-shaped scenario, and basically suggest that the economy will contract by more than 10% this year, capital investment by nearly 20%. One of the benefits is that inflation will remain fairly low at 3.5%, and this obviously has already facilitated a drop in interest rates. But I think one must be very careful not to anticipate further declines in interest rates, because one is starting to see some danger signs on the inflationary front. And as for the exchange rate, it has rallied quite nicely in recent weeks, from lows of over 19 Rand to the dollar. But I don't see that being sustained for any length of time, because one of the effects are, and here's an international comparison, one of the effects of this horrific hit, these are the IMF forecasts, in April they were a bit more optimistic. They said minus 5.8% for the South African economy this year. Since then, 2 days ago, we saw the World Bank saying minus 7.1, and now last night I see the OECD saying minus 7.5, so they're all tending towards minus 10 kind of outcome that we're looking at. But there is huge variance in the kind of scenarios for growth. I've seen, on the one hand, you have those who are looking at minus 5, minus 6, minus 7. On the other side, you've got Business for South Africa that is looking at minus 14.5, and I believe National Treasury is even looking at a worst-case scenario of minus 16, and we are slightly in the middle at minus 10.7. But one of the impacts be that as it may, whether it's -5, -10, or -15, is that there's going to be a huge hit on tax revenues, and so on through that on the ability of the South African government to actually pay its way through this crisis. But it's not just the South African government. As you can see internationally, the likes of US, Europe, and China have all suffered dramatic declines in economic growth. Another funny graph is this of US employment, where you saw a 25 million increase in the level of employment in the wake of the global financial crisis of 2010 all the way through to 2020. And in just 1 month, in April, 22.5 million jobs were lost. You'll notice there was an encouraging regain of 2.5 million jobs in May, but we still, it's a crazy graph really in the broader scheme of things. But as I mentioned, tax revenues are going to fall dramatically short. In South Africa, we are looking at a prospective hole, in other words, a shortfall in tax collections of some 400 billion rand compared with what one might have expected, with what we budgeted in February. In February, that's only 3.5 months ago. We're already looking at a shortfall of 400 billion, or 7.5% of GDP, over and above the shortfall of 6.8% that was even then already budgeted. So we're looking at the budget deficit screaming up to close to 15% of GDP. And with that, public debt levels are set to scream upwards, depending on which scenario one would have selected. And obviously, if we're looking at -10.7%, we're looking at government debt to GDP ratio rising closer to 100% within the next 3 years. Now, many would say, but there are lots of countries with public debt levels close to 100%, the United States being one. The difference is their long-term interest rates are close to 0, and ours are up at 8, 9, 10%. And that is why I think one must not be unduly optimistic about the rand returning to levels of around 13, 14 to the dollar, even though we've seen nice gains more recently. I think the huge fiscal deterioration in this country and the downgrades will eventually catch up on us. Having said that, it's very important to highlight the fact that the rand's movements are being influenced more than anything, not by the deterioration in our fiscal situation, but by global sentiment. Towards the end of 2019, one actually saw the rand appreciating from 15.5 to below 14 to the dollar at one point, mainly because people were anticipating a new trade agreement between the United States and China, and that therefore the world economic outlook would improve massively after that. In the meantime, locally, we were getting terrible news about the downgrade in the outlook for our credit ratings, the huge increase in the budget deficit, even in the medium-term budget policy statement. And SAA was on strike, and Eskom was threatened, took us all by surprise in December with renewed load shedding, and yet the rand was gaining ground. But then it all changed after 15th of January, when that trade agreement was signed between the US and China, with the outbreak of the COVID virus and panic stations. And those panic stations saw the rand blowing out to over 19. And no sooner had it done that than people started becoming optimistic that we're starting to see a flattening of the curve in many countries. The rate of fatalities is slowing down, and we might get a vaccine discovered quite soon. And that has enabled a lot of countries to start lifting the lockdowns, and confidence has been restored. And so we're seeing the rand gaining ground a little. But even so, as I mentioned, I think the terrible fiscal situation will prevent that from the rand from gaining too much ground, notwithstanding the fact that by historical standards, we are very close to the all-time lows, with the exception of the horrific sell-off that we had in 2001. But this is a very cheap rand even now. So I don't believe it's going to collapse, but I don't think we should expect it to go back to 13, 14 to the dollar. Long-term interest rates likewise have followed the same pattern of the rand. A massive sell-off in March when everyone was panicking about the global impact of the virus, and then a countervailing massive appreciation since then. And we're almost back to where we were on the financial markets prior to the global crisis. You see the same spike in terms of the difference between our long-term interest rates and those in the United States. And by the way, even currently, there's more than a 6% differential, and that still renders South African bonds quite attractive for those international investors wanting to take risks, especially in relation to a global environment where interest rates are down at close to zero. The one aspect that has become very apparent in recent times, you'll notice that the difference between short and long-term rates in South Africa has steepened massively in recent times, the so-called yield curve. There is where it was 6 months or a year ago. This is where it is currently. You've got short-term interest rates at around 4 or 5%, long-term interest rates at around 11 and 12%. Why? Because investors have become terrified of the longer-term future. How are we going to manage to clamp down on the rise in our public debt unless we get very much higher economic growth and to generate the tax revenues needed to start repaying that debt? And where people have lost a lot of confidence in our ability to regain high levels of economic growth because of a reluctance on the part of the government to really move ahead with structural reforms on things like fighting corruption, improving the state of state-owned enterprises, investing in infrastructure, improving educational outcomes, quelling the tensions in the industrial relations environment. And until we tackle those problems, even after the virus, the feeling is we will still not be able to generate the kind of economic growth that is needed to raise the revenues required to pay off our debts. Under those circumstances, we could be headed for a massive debt crisis in the longer term. And so investors are happy to invest short term, but not into longer term bonds. Remember that with the horrific increase in our public debt, the government's debt servicing burden is set to escalate fairly dramatically, and by around 6 or 7% of government spending. In other words, within the next 3 years, the government will have 6% less available to spend on education, healthcare, security, and all that, given the amount that it just has to spend on paying interest out to bondholders. Just a quick view on inflation. It has come down fairly sharply in recent times, but don't be fooled. You're going to see fuel prices rising again quite strongly early next month. And so any sharp fall in inflation that is expected when the figures are announced in 2 weeks' time is likely to prove temporary, and we're going to see a reversal in that trend later on. As I mentioned, there's evidence of faster food price increases during lockdown. It now looks like electricity tariffs may rise by more than we originally anticipated next year, because NERSA has allowed Eskom the ability to increase tariffs by more in order to recoup some of its costs. And then the other thing is, you know, in this environment with fears about a shortage of supplies, of constraints on the supply chain, you could get moves towards inward industrialization and import replacement. That's very nice for some industries, but it does come at a cost. And the general cost structure of world economies could well start increasing in due course. And finally, of course, the rand has taken a big knock. And once the forward cover contracts on imports that people may have taken out at the beginning of the year start dissipating, we're going to see prices start accelerating again. Given that, I expect that inflation will go back up to around 4.5% next year. And with the repo rate currently at 3.75%, there's no way the Reserve Bank is going to want to cut interest rates still further in the short term. Although, yes, last night I was watching Jerome Powell, the head of the Federal Reserve Board, saying how American interest rates are bound to remain at zero for at least the next 2 years. So some will argue, well, that does give the Reserve Bank scope to cut interest rates a little further. Just to talk about the stock markets, unbelievable. Look at that reversal. As I say, it's all on the back of money being thrown at these shares, because what else do? You keep it at very low interest rates. This was a graph that I saw in the Financial Times about 2 months ago, which showed that even at that time, in the first stages of stock market recovery, people were already looking at forward valuations, price earnings ratios on shares there being higher than at any stage in the last 2 decades. And it's just got worse. And in a survey conducted by Bloomberg earlier this week, 79% of people believed that shares were overvalued. And yet the markets keep rising higher because of this massive amount of liquidity being added to the global financial system. What's the end game? I mean, can you carry on forever? I fear that in due course, you could just see a massive inflationary spiral worldwide. And that is, of course, the solution in the long term, because we've seen huge increases in indebtedness, both of individuals, but even more importantly of governments over the past few decades. And with the latest huge stimulus packages, those debt levels are going to get even higher. And you know, the easiest way of eliminating debt is to inflate your way out of it, because the real value of debt then actually just dissipates. It's a scary scenario, and that's why I would suggest that it raises all sorts of potential avenues for disaster, one of which is that inequality around the world is rising sharply. As a result of all this quantitative easing, the wealthy are doing fairly well out of their shares and bonds, etc. But the man in the street is losing his job and penniless and impoverished and hungry. The other aspects that I have found quite ironical with this whole COVID thing is the big retail stores were allowed to remain open, but the small ones had to close. There's been less scope for bargain hunting, which helps keep prices down. Now, on the education front, those people with whose kids, with children who are able to use iPads and laptops and are able to communicate with their private school teachers and carry on their education now during lockdown. But the people living in outlying areas with no such IT equipment are being left behind. The digital divide is getting bigger and bigger. Also, so many of people in outlying areas have been relying on sending their kids to school just to receive food, and now they can't do that easier. And the bureaucracy of enforcing the lockdown has arguably come down much more heavily on the poor and small businesses and the poor, like the informal sector, than on big businesses who are able to cope and apply nicely and properly for all these relief packages. I mean, I found it a joke that informal businesses were obliged to apply for licenses to operate. And of course, social distancing is so much easier for people living in big homes and in wealthier areas than those living in informal. All of this is a worldwide phenomenon, and also, by the way, lies at the heart of some of the protests that we are seeing internationally as a result of, I think, not just racial attitudes, but also perception of this growing inequality. It's not all, of course, bad news, but I think what one should be expecting with this huge overvaluation of shares is more of the kind of volatility that we saw in March in the markets. And I wouldn't be surprised to see another big sharp downturn at some point in time over the coming year. Gold obviously being one way out of it. Finally, just to bear in mind that even in a fairly depressed environment, the world is going to change post-COVID, and this is going to set up a whole host of new areas of opportunity in the healthcare field, in digitization, in educational technology, in cyber and other security systems. And of course, the one thing that the lockdown has taught us is how nice it was to see clean air, birds returning, animals returning to towns. Environmentally friendly solutions are going to become the order of the day in due course. And if one can take advantage of investments and opportunities in these fields, one could do very well. And of course, the top one, with less globalization, more authoritarianism and nationalism as a result of the kind of inequalities that are generating and the populism that they're generating, this is going to pave the way for opportunities in import replacement, because businesses are not going to want to trade quite to the way they've done in the past. There's a lot that I've tried to squeeze in here, but thank you very much for your attendance.